As I told my clients over the years, not every gift is a good gift. In fact, some gifts can cost a not for profit far more than they're worth. Welcome back to Joe Talks Nonprofits. I'm Joe Blatt, and as many of you know, I spent the past 40 years as an auditor and consultant in the not for profit industry. Today, we're taking a deep dive into non cash contributions, what they are, how they should be accounted for, and why a strong gift acceptance policy is one of the most important governance tools a not-for-profit can have. When people think about charitable contributions, they usually think about cash, checks, credit cards, maybe even stocks. But in reality, nonprofits receive all kinds of non-cash contributions, volunteer services, donated property, vehicles, art, supplies, and even digital assets like cryptocurrency. Some of these gifts are incredibly valuable. Others come with legal, financial, and administrative risks that boards and managements don't always anticipate. Today, I want to look at non-cash contributions through three lenses: accounting and GAAP requirements, governance and risk management, and IRS compliance and reporting. Whether you're a board member, an executive director, or someone in the finance office, this is one of those areas where getting it wrong can create problems years down the road. Let's start with the most common and most misunderstood type of non-cash contributions: volunteer services. Well-run nonprofit organizations rely heavily on volunteers to reduce the cost of labor. For most organizations, labor is the single largest expense on the income statement. That includes salaries, benefits, contracted labor, and professional fees. Volunteer service comes in many forms. Think about volunteer firefighters and ambulance drivers. Think about organizations like Habitat for Humanities, Doctors Without Borders, the Girl Scouts, parent associations at your local schools, and many others. In some nonprofits, volunteers may represent 20% or more of the workforce. From an accounting standpoint, though, there's a key question: which volunteer services get recognized in the financial statements? Under generally accepted accounting principles, or GAAP, volunteer services can only be recognized if they meet the following criteria. First, the services must be performed by somebody possessing specialized skills. For example, an attorney, an accountant, a doctor, or an electrician. The services must be provided by individuals who actually have those skills, and they must be services the organization would normally have to purchase if they weren't donated. Secondly, the services can be recognized if they create or enhance a non-financial asset. Common example is construction labor. If volunteers help build a house, the value of those services become part of the cost of that house. If either of these conditions are met, the organization should be recognizing both contribution income as well as contribution expenses for these services. This is an area that's easy to miss. No cash changes hands, so it doesn't automatically hit the books. Auditors don't always ask about it. Outside consultants may not think about bringing it up. That's why accountants, finance staff, and board members need to be proactive. You may ask, why does this matter if the net effect is zero? After all, donated legal services create revenue and expense that offset each other. Here's why it matters. If those services stopped tomorrow, the organization would suddenly need to pay for them. Recognizing them helps tell the full story of what it really costs to operate the organization. Valuation is often where organizations get uncomfortable. The simplest approach is when the volunteers providing these services also provide similar services for a fee. In those cases, they can tell you what they charge. If that's not available, you can look at what similar services cost in the marketplace. When that doesn't work, you may need to rely on published rates or other reasonable estimates. Whatever method you use, documentation is critical. Over the years, I've had many difficult conversations with organizations that cannot explain or reconstruct how they value donated services. Now let's talk about volunteers who don't meet the GAAP criteria. Parents wrapping holiday gifts, volunteer staff events, people helping with programs, those contributions are invaluable, even if they don't qualify for recognition in the financial statements. Best practices here is to track volunteer hours and include the appropriate disclosures in the notes to the financial statements. You can even include estimated values as long as you clearly state that the services didn't qualify for recognition under GAAP. Beyond volunteers, nonprofits receive a wide range of non-cash contributions, and real estate is one of the most complex. Property donations often come through bequests, houses, apartments, or land left to the nonprofit in someone's will. In many cases, there's no restrictions, and the organization sells these property and uses the proceeds to support their mission. But sometimes these gifts comes with strings attached. Maybe the donor wants the land to be used as a camp. Maybe they want a historical home preserved, or maybe it's land that they want part of it to be maintained as an easement for the town to pass through it. This is where a comprehensive gift acceptance policy becomes critical. From a governance perspective, a gift acceptance policy should ensure the gift aligns with the organization's mission. It should define who is authorized to accept different types of gifts. It should establish thresholds for board or committee approval. And it should identify gifts that require additional review, such as real estate or closely held assets. The goal is to help management evaluate gifts consistently and escalate decisions to the right level. A good policy also helps ensure that gifts don't violate the law, jeopardize exempt status, or create unnecessary liability or administrative burdens. Let me give you an example. One organization I worked with received a bequest of land in a foreign country. On paper, it sounded generous. In reality, they had to hire a foreign legal counsel just to transfer the property. By the time they were done, they realized that the time and money they had to invest far exceeded the cash they ultimately sold the property for. Other times, properties may come with environmental issues that expose the nonprofit to liability. Once the gift is accepted, those risks belong to the organization. From a GAAP perspective, once property is accepted, it must be recorded at fair value. If the property is sold immediately, the sales price generally establishes fair value. If the organization plans to hold the property, valuation may require an appraisal or comparison of similar sales. If the gift is material, I strongly recommend an appraisal. Often one has already been done by the donor or by the estate. And a common misconception: restrictions do not change the fair value of the asset. Property restricted for use as a camp is still recognized at its fair value. Another common scenario is free or discounted use of property. If a donor allows a nonprofit to use space at no charge, whether temporary or long-term, the organization needs to determine the fair value of the agreement and record it. If rent is discounted, you need to be careful. Is this truly a donation, or is it simply a business decision by the landlord? Documentation matters here. Many nonprofits have vehicle donation programs, cars, boats, and similar items. These items are typically sold immediately, and the sales price establishes fair value. Other common non-cash gifts include artwork, collectibles, program supplies, thrift shop inventory, digital assets like cryptocurrency. The valuation process is generally similar. Looking at comparable items in the marketplace, donors who claim a deduction frequently are required to file a Form IRS Form 8283 along with an appraisal. These can often be used by the nonprofit to help determine fair value. When appraisals aren't available, ask donors for supporting information. For used items, online marketplaces can provide useful data. For new items, you can look at retail pricing. Again, documentation here is the key. Digital assets such as cryptocurrency have a fair value, but are not treated the same way as publicly traded securities. Most organizations that accept them sell them immediately. Because there is tax advantages for donors, it's important to address digital assets clearly in your gift acceptance policy. Having the wrong mechanism or no mechanism at all can cost you donors or create compliance issues. Let's talk about IRS compliance, because this is where nonprofits often get tripped up. The IRS Form 8283 is filed by the donor, not the nonprofit. However, a not-for-profit organization is required to sign the form acknowledging receipt of the donation. By signing this, the nonprofit does not agree to the valuation. What they are agreeing to is to notify the IRS and the donor if the asset is disposed of within 3 years, to disclose whether the donor asked the organization to hold the asset for a period of time. If the nonprofit disposes of the asset within the 3-year window, it needs to file a IRS Form 8282, which needs to be filed within a certain time frame, and a copy of that is sent both to the IRS and to the donor. This is why a gift acceptance policy should clearly state who's authorized to sign the Form 8283. Once it's signed, it forms a 3-year compliance clock that starts ticking immediately. Let's wrap up with a few takeaways. If you're a board member, ask to see your organization's gift acceptance policy. If there isn't one, now's the time to create it. If there is one, read it and ask whether it still reflects the organization's risks and activities. If you're in the finance office, make sure everyone involved in donor relations understands the policy and knows when to escalate decisions. Smart fundraising isn't just about what you receive, it's about what you prepared to manage. Thank you for listening, and I'll see you next time on Joe Talks Nonprofits. This podcast is intended for general informational and educational purposes only and does not constitute accounting, tax, legal, or other professional advice. Listening to this podcast does not create a client advisory relationship. The information discussed may not be applicable to your specific facts or circumstances. You should consult with your own professional advisors before making decisions relating to accounting, tax, legal, or governance matters.